Howdy, Jacob here. Today we're looking at the company GES. All right, specialty retail industry, pretty similar market cap and enterprise value, about 150 million in net debt. Not bad. Price to earnings looks very cheap right now. Balance sheet: $382 million in long-term debt, 276 million in cash. So that's roughly, the 100 million. And then capital lease, 540 million. Okay. Um, okay. Since 2020, very consistent on the free cash flow. I guess just 2019 and 2017 were tough. Outside of that, they've been producing very solid cash flow. So that's good to see. 160 million, 70 million, 70 roughly, 180. I mean, I guess we can assume 100 million, let's say, because we're including this down year. Let's say 100 million on average. They can afford 59 million payout, and that's 5.31%. 100 million with 382 in long-term debt, less than 4 years, roughly on average. That's manageable. Um, it looks like 1.2 is more than they've paid out historically, but I think it's safe to say that that 1.2 can very likely hold, and then with the excess money elsewise, otherwise they can. Looks like they buy back a good amount of shares. Okay, so they buy back a lot of shares, pay a little dividend, not too much in acquisition, if at all, and then looks like they've been issuing a little debt, really just here and then sustaining it. But use of free cash flow, not terrible. Let's get to some assumption setting here. So 2.5 billion in 2014 and now 2.7 billion. So looks to be a nearly no growth industry, um, or no growth at least over the last 10 years. Was there any? Okay, a couple acquisitions, a couple de-investments. Maybe I'll assume 2%, and then they'll have a little bit of growth left. 12p price free cash flow, 15 on the discount rate. As for margins, is that roughly 3 and 4? I'm comfortable with that. Buying back a lot of shares. Let's assume 3% buybacks. And then, yeah, dividend we said was solid. And with their excess free cash flow, they'll also buy back some shares. Honestly, a pretty interesting company here. So this might be one of the few we've seen that also buys back shares along with issuing a dividend. And to me personally, I think this dividend can hold. I think the payout is definitely reasonable. It is. It looks to be a somewhat cyclical business, um, but they usually produce very solid free cash flow that can more than make up for their dividend payout. And then their share buybacks are also helping that um, go up. So let's say that their dividend payout was, um, you know, $10 a share, and they bought back a bunch of shares. They bought back 50% of shares. It's still $10 a share, but half the they only have to pay out half from a total perspective, total cost perspective, because there's 50% of the original shares. So on a per share basis, um, if on a per share basis it doesn't change, then buying back shares will just have them pay out less, which or they could increase their dividend. Both work. So this might be an interesting company to look at. I think right now it's at a little bit more frothy price than I would be willing to get into it, but with a very solid dividend at 5%, and then them buying back a lot of shares, this could be a company that does a really good job at just giving money back to their shareholders. So um, definitely put it on your list and do your research on it. I think it's interesting enough to at least do that. So thank you and have a good rest of your day.